Please welcome to the stage our next panel, How Rental Housing Deals Get Done and Financed.
Good morning. Our panel is called How Housing Deals Get Done, and we're going to talk a little bit about financing strategies and what's working, what's not working. So I thank everybody again for being here today. My name is Justin Golden, one of the co-founders of Detroit Living and Greatwater. We are a property manager, and we own and operate thousands of apartments in the city of Detroit, and we now manage them ourselves. I'm very happy to be here today and care very much about the topics that we're discussing. I've got a great panel here. This is our first panel, and I would encourage everybody to chime in. We'll have some Q&A opportunities, and we've got some floating mics, I believe, and they will make their way around if you have a question for the panel. So please feel free to share and ask questions as we go through our session here. With me, I've got three esteemed colleagues in Detroit. Brandon Hodges, he is the principal and founder of Tribe Development. Damon Hodge, just one less letter in that name, but similar. He's the vice president of lending for Invest Detroit. And Cliff Brown, he's the president and CEO of Woodbourne Partners. So I want to thank you guys for coming and joining me today, and looking forward to what we discover. So Matt talked earlier about the word viability. It's an important word, and it's one that I'd like to try to touch on with my panel here. Why is housing so difficult to create in Detroit? Some have said it is impossible to build new housing in Detroit. That's a strong word, and it's controversial. There's some arguments to be made that it can only be done with government subsidy, and that is limited in its own. So we have to find other ways to create housing. So I would like to ask my panel, and each of you can take a moment to answer it in the way that you feel best represents your perspective. Is it true that housing is impossible to create in Detroit?
No, it's really hard. The math of housing is a little simple, right? And I think the cost to build something has to value itself, and if the replacement cost is higher than the value of a building, usually it either doesn't get built or you need a ton of subsidy to build it, right? And I think at its base case, that's the math that we all are doing every single day, and that varies from deal to deal. We specifically focus on low-income housing tax credit work. We also dabble in kind of neighborhood corridor work. I'll give you real numbers. The building that we're working on right now in East Jefferson is a $21 million development cost, all in. The value of that building on paper is $6 million. The only way that building is getting done is subsidy, right? For sale housing probably is a bit simpler. It works where it works, it doesn't work where it doesn't work, right? If it costs $250,000 to $300,000 to build a door, you got to sell it for that just to break even, if not more, just to eke out a profit, right? And so I think from our perspective, we know that it's going to take subsidy going in, and so our business model is premised on that. But is it impossible? No, but it's critically necessary in most instances.
If I could take it a step further, I wouldn't even say replacement cost. I would say I can't take on more debt and equity than what the building will be worth on the back end. Because ultimately, as much as I care about Detroit and all of us care about Detroit, I'm married, and I don't want to lose my house at home. And that always has to be the first thought. I always describe real estate development as an airplane crashing. And when an airplane is crashing, which, you got to think logically and everything, and I don't mean to say that is the state of the city of Detroit. I think that is real estate development in general. And when an airplane is crashing, it is not selfish to say, I need to put on my oxygen mask first. That is a reasonable thing to say. And as developers and as investors and as stakeholders in the city of Detroit or in any city, that is our responsibility. I'm currently building a building in West Village. It is a $16 million build. The valuation is $10 million, right, when that thing is built. When my abatement falls off, the valuation is $5 million. So the question that you all should be asking is, why build it? Because it is necessary. We do ground up mixed income. We feel like that not just we create amazing spaces in terms of physical buildings, but we create amazing environments in the neighborhoods in which we build. We are partners in those neighborhoods. The work that we are doing is necessary, but we have to find a way to make it financially viable to continue to do so. I joked as I was walking up in terms of how do you get this done, and I said, I'm just going to say Dave Blaskowitz, right? Because every deal that we have done, they and other partners, Kevin Ryan, other partners have been involved and been engaged in. And I think the work that we are doing is necessary. I think we have to continue to build, but we can't put our head in the sand in terms of identifying creative solutions that is not always about relying on other partners. I'm able to build buildings. The challenge is, can I build a business? Because my model is not scalable. So we've been doing this for 10 years, and the question becomes, why can't we get away from CDFIs? I can't build a balance sheet if everything that I build costs more than what it's worth on the back end.
Thank you for that.
Yeah, not a lot to add. I think you've heard it directly from two guys who live this every day. I would say the one thing, and from a lender's perspective, number one, I agree 100% with everything they said. The other thing is, as a loan officer and as a provider of capital in this industry, we would love it if this wasn't a market where we did not need all the subsidy, because frankly, a lot of what we do at Invest Detroit is that we do help to advocate for investors like and developers like these two gentlemen, because we recognize it's tough for us to get deals without the subsidy. It's tough for any deal to happen in this economy. And I mean, I'm not telling you anything you don't know. If you've paid attention for the last 45 minutes at all the data and other folks that preceded this panel, I mean, you heard what the numbers look like, right? And you heard what Cliff said about the numbers. The math just isn't mathing. So it's not impossible to do these deals, but it is impossible without some of these supports, whether it be funding directly from local or state government, municipalities, if it's some form of tax credit equity that's coming into the deal. But that idea of just debt and call it 10% equity, that model is not functioning right now in Detroit. And the data that we heard earlier explains a lot of the reasons why.
And not to, and I promise I'll shut up because Matt
going.
knows I can talk about this forever. The other piece of it that we can't ignore is that we have to find a way to work collectively to get incomes to rise. Because construction costs continue to rise, and we yell at developers and we yell at everybody and say, why are rents rising, right? But we cannot continue to have valuable properties if rents don't continue to rise. And by valuable, I mean actually just sustainable properties. But we've got to find a way to have incomes rise at the same level that construction costs rise.
Appreciate those thoughts. Thank you. Yeah.
What does it mean? What does it mean if you build something for $10 million and then it's worth $5 million? Why?
For $16 million and it's worth $10 million.
I was just trying
and
to
then when
make
abatements fall off, it's $5 million.
I was trying to make it simpler, but I'm just saying, like, what is it like? If I build for something for $10 million, it should be worth $10 million, right? Like, why isn't it? I guess is maybe like for the people here. I get it. It may be useful to.
Yeah, just briefly. I mean, it's basically a cash valuation model, right? If the property's only bringing in X in revenue, that is a direct reflection of what the property is worth. So yeah, the building cost, it may be $16 million, it may be $20 million. But when you break down to what is the value in that property, that is a direct reflection on, and there's only two valid ways to value a property. It's not construction costs or cost to develop. It's resale value or cash flow. And in particularly multifamily mixed-use property, it's based on the cash flow. So if your rents, which are a direct reflection of what your tenants in the market can afford to pay, if your rents are X, there's a mathematical equation that leads to what is that property worth in terms of actual dollars in a refinance market. And until those incomes are raised, as Cliff was indicating, your value in your property is not going to catch up. So it does become a bit of cat and mouse between what is the income, what is the cost to build, and what kind of revenue can you bring in to validate the value in that building.
And not to go too far down a rabbit hole, but like I try to teach my kids this calculation, right? And so if you think of the valuation of a building, it's really simple. It is rent less operating expenses equals your net operating income, divided by an index, which in this case is a cap rate, gives you your valuation. So effectively, either your operating expenses have to go down, which we know are not going to be the case, or your rents have to go up in order to increase that value. And so that's where we say incomes have to go up because we can only charge so much rent. It only makes sense to charge so much rent to people who are trying to live and trying to survive. But on the flip side of that, we can only build or maintain so much if construction costs are going up and the cost to maintain buildings is going up.
Yep, thank you for that. You touched on it a couple different ways about attracting, how do you attract capital to a city where the math is what you just described, which wouldn't work for a lot of people. It feels to us, when we first started our business 12 years ago, no one would lend us money. And I think we had to do our first couple investments with just equity. And it was challenging to do that, and it's even harder to make the math work for an equity investor who's looking for a market rate return on their investment. We were lucky a couple years into our business, we met James Kelly, raise your hand. He actually came in from Atlanta, so thank you for coming. He helped us get into the market to borrow money and using Freddie Mac and Fannie Mae and the different agency lenders in order to further our efforts and invest deeper into Detroit. But it was literally him. He came here to see it and believed in it. How do we get more people to come here and see it and believe in it with us? How do we attract capital, whether it's lenders, equity investors? How do we get them to see the opportunity and why they should care and why they should contribute to this city?
If I could, one of the things that we advocate for, and I'm a little bit biased because I talk to these gentlemen every day, we advocate for developers and for investors and for the people who are making these projects happen. I think there needs to be, and it was touched on earlier, there needs to be a concerted effort not to demonize our developers and our investors. I think it's a political talking point oftentimes that, hey, these developers, they're gouging these projects so that they can, live fantastic lives and they're multimillionaires in that. And hey, some of them do okay, and some of them do more than okay. But I mean, these are investors, and these are people who, as Cliff indicated, they're doing this because they've got a household, they're trying to build a life, and they're in this industry for a reason, and they're doing this to make money. Now, should they be doing this necessarily to be quote unquote rich? Well, that's another discussion. But many of the developers that we work with in the city of Detroit, these are not multi-millionaires in that sense. One of the things that we've found with the developers that we're able to attract, one of the through line similarities that we see with them is, and I know it sounds great, at a groundbreaking, they say, I did this because I grew up in this neighborhood and my grandmother lived down the street and that. But I think most, if not all of the developers that we see who are really determined to do projects in Detroit, there is a strong connection and a desire for that benefit to hit in Detroit. Because I think when you do the math and you look at the economics, from a financial and from an investor perspective, the case could be made that, hey, you could go to, Troy, you could go to Novi, you could go to somewhere else, even within metropolitan Detroit, Southeast Michigan, and your bang for the buck or your return is better. But the developers that we work with, they all have this common theme that they want to work in Detroit. Now, that's good and bad. Number one, it's good because they understand what it takes to build projects in Detroit, right? And so I think a lot of the developers and folks who are doing projects outside don't realize quite how difficult it is, both in terms of economics as well as just working through the myriad of the approval process and the getting a project off the ground and through the city hall and all of that kind of stuff. So, I mean, you have to be kind of Detroit specific from that standpoint, but I think there also has to be a desire that this has to make sense sometime beyond the economics, understanding that you still want to see projects make money, but I think that desire to have something that there's a bit of an emotional connection to, and you want to help see the city progress, I think that connection has to be in place, because I'm not sure that from an economic standpoint it always makes sense. So I think we have to attract developers and make them feel welcome for, in a lot of ways, what they're doing is of community service. And I think it needs to be looked at as that, and we need to stop demonizing them as these rich investors coming in to just steal money and get rich.
So I'll take it a little bit more into a nuanced place, because I think we need to talk about details and why things are different for different sources of capital. Debt and equity are different. And everybody, do you understand why? Okay. I get money from a bank. I have to pay that money back, right? And in my world, debt is a bit of a commodity. So long as your cash flow can hit the debt service that your lender is willing to put on the property, and you can predictably pay that back, you can typically get debt. Equity is a totally different beast, right? Like, equity has options. For the same reason you said that somebody can go to Birmingham and have a guaranteed stream of income and people paying rent on time, if I have $1 of capital to invest, and I can choose between Detroit, Birmingham, or any place else to put that money, where would you put your money? If not for passion alone. And I think to Damon's point, there's obviously, like, we live in the city, we're doing work in the city. Passion is going to keep us doing work in the city. It's going to keep you guys doing stuff that's very difficult to do. Equity doesn't work that same way. Equity is going to go where $1 can turn into $1.20, period. And $1 can't turn into 75 cents. That's kind of the reality that we're facing in the city of Detroit, right? And I think, let's get a little bit more nuance. When the fact of the matter is that when values are less than replacement cost, you almost kind of default to a low-income tax credit equity model. That's exactly how our projects work. Equity accounts for 70 to 80% of our project development stack, right? Because of the fact that we couldn't convince a market, like, I can't go and convince a market rate guy or a market rate equity investor to come and put money in my deal if I can't guarantee, A, that there's a refinance that's coming or a liquidity event. And I think one thing that we haven't said is liquidity is a huge issue in our city. We don't operate the same as most major American cities in the sense that you build a building, you stabilize a building, you refinance the building or sell the building within like 3 to 5 years to a REIT or a pension fund or whoever else. We're going to be like asset rich and probably liquidity poor at the end of the day. That's not how this model can be sustainable, right? We can't afford, I mean, we're defaulted to do it because we're in the low-income housing tax credit business. And if you don't know, we have a 15-year compliance period because we're going to be in that deal for the first 15 years anyway. So we kind of know that works. If you're a market rate developer, your goal is not to hold a building for 10 to 20 years. You need to create a liquidity event to pull cash out to go on and do the next thing, right? So I think part of the issue that we're going to have to reconcile in the city is, one, incomes, but what is going to make the city of Detroit attractive for market rate equity to come in, take the risk, and believe that there's any predictability around making their dollar at the end of the day? We have a co-developer out of Philadelphia. We were having this conversation earlier this week. Sometimes we stand too close to the issue as being in the city of Detroit because we don't necessarily have all the vantage points of how other cities function and operate. And he made the point to me, he was saying that you wouldn't understand how hard it was to convince our investment committee to let us come to Detroit to do a deal. That's the reality, and that's a developer saying that. If a lender is reading Cranes and sees that 4 or 5 buildings are going back to the bank, it's not a great narrative, right? Like, we're gonna have to start reconciling the inherent issues that we know we're facing in this city, because to Annika's point, we're gonna lose lenders, development shops are gonna go under because we need to have a viable and solvent business, and tenants are gonna suffer at the end of the day. Like, if you have no viable way to creatively and productively build housing, which we're already at a deficit at, good luck if we keep at the pace we're going.
I'm a market rate developer. I am here because I love the city. I could look at Richard, I could look at Roderick, I could look at David, I could look at Sonia, and it does not matter, when I sit in front of council, it does not matter that I love the city. I have to go raise market rate equity. And I can't even beef with them because a lot of the money they're investing is my retirement account. It's your retirement account. Do you want somebody to be risky with your retirement account? I have a mentor who is not in real estate development, and it's helpful because, like you said, he's got some distance. And I described to him the market in the city of Detroit and why I'm doing market rate, and he said to me, when an emperor goes to the circus, it does not make the circus the castle. It makes the emperor a clown. He said, you're a clown. You're trying to do market rate development in a city that is not welcoming to market rate development. And I looked at him and I said, if I could do this anywhere else in the world, I would. I absolutely would. But I love this city. And we have to expand beyond the city to survive, but I can't help investing in this city, which does not make logical sense. Because I love this city. And the city does not just need affordable housing. It certainly does. But it also needs market rate housing. It needs middle market housing. And so the easiest thing in the world for me would just be to put Detroit down, go to other markets, never come back to Detroit. And so we're looking at a market and saying, do we have to, as a business model, pick up other markets and treat Detroit as a loss leader? And say, we're going to continue to do this because this is why we exist in this space. But in order to survive, we have to split resources. We have to split our attention and go to other markets so that I can pay my bills.
Thank you for saying that. Thank you for sharing the honesty. We appreciate the honesty, too. We've got about 9 minutes left in this session. I want to make sure that if there's questions that would be for any of the groups or any of the members up here, please, now's a good time to raise your hand. And please share. We got one over here.
Thanks, guys. Real quick, you talked about like real barriers, math barriers, lending barriers. Could you talk about some of the barriers that are maybe lower hanging fruit that the city, policy-wise or neighborhoods could take on that would make these things just incrementally easier to build, market rate housing, things like that?
So I'll say this, and this is not meant to embarrass anybody. This is a challenge that we have at the legislature and other places. We're building this building that is $16 million. It does not make sense. It's 47 units. The last two buildings we will have built are 78 units and 47 units, and they have taken 5 and 7 years to get done. The math doesn't make sense. And we go to build this building. We have challenges in terms of design issues. Okay, that's fine. And then we have challenges because at the state legislature, they say it has to be mixed income housing. And so we say, look, we're going to put point of sale retail because we have this amazing community space for the residents. And the feedback we got was, and we said, look, the solution, right, is going to be that we're going to lease it to our retailer from 7 to 5 every day, and then it'll be available to our residents after 5 p.m. so that that retailer isn't paying for dead space. And the feedback we got was no. And I don't blame them. They're working within the constraints that they have. So we solve for that problem. And then the next problem goes, hey, we're getting a grant for the state. And the grant requires that we leave 100%, we defer 100% of our developer fee. And I say, how do I keep my lights on? And again, I don't blame the state for it. I don't blame the people who work there because they have a legislature, and I'm not knocking them. I'm just saying that says if you're getting a developer fee and you're getting a grant, it's just going in one pocket and out of the other. And I said, how does this make sense? I'm getting a $600,000 developer fee for a deal that took 7 years to get done, and I have incurred bills the entire way. I'm not putting that in my pocket. I'm going to pay off my credit cards for trying to get this done. And the feedback was, hey, you've got to defer 100% of your developer fee. And they're working with me to solve a problem in terms of at a staff level, because again, I needed to be very clear. This is not a staffing problem. This is the way that we look at this thing at a legislature perspective. How do you ask anybody to do any work and say, you have to defer 100% of your fee? In what world does that exist? How does that make sense for anybody? And then I asked myself again, you know what I said as I walked away? You're a clown.
I mean, I think there's also some, I echo everything Cliff says. I was joking with David a lot in the back yesterday, and even when we pursue subsidy, there are strings attached to that, right? We are taking free money that then has to be bridged because the MEDC won't let you put all that capital in the deal to start. You have to complete your project. That money comes, the lion's share of it comes on the back end. Our deals are arbitrarily more expensive because we chose to take a grant that then has a tax consequence. Absolutely. The model doesn't really, this is the most asinine thing that I've ever had to deal with.
Real quick, clarify that. When you say tax consequence, not to the building, to you personally. It is treated as personal income.
It's income.
Don't take a developer fee, take this grant, and it's going to tax you at a personal level.
So now you're at a loss.
So literally, we have a deal, a perfect profile of a deal that everybody, every council person, the mayor says they wanted in their community. Commercial corridor, SNF neighborhood, total deal cost is like $5 million. $3 to $4 million is grants and subsidies of some sort. We now have to reconcile the fact that we've added like $300,000 to $400,000 in financing fees, interest carry alone, because the grants and subsidies we took. to pencil a capital stack. So we're getting, it's almost punitive to do deals here because you're actually getting penalized for taking the thing that you need the most. And then you're going to get hit on the back end of it because of this income event that we're still having to figure ourselves out of. But I can't afford to do that. And to Cliff's point, our whole model, we can't be in deals 5 and 6 years and not get paid. We will close our doors or we will choose to go to a different city, right? And obviously that's a personal issue for our companies, but that is not anecdotal. Nonprofits at least have the ability to go to foundations and support themselves through operating capital of sorts. We are not that. We're for profit. So every dollar that we make gets reinvested into either pursuing more deals, paying staff, paying consultants, and to defer 100% of your fee just because the MBDC says you should be grateful that we gave you money is effectively what they're telling you. It just doesn't work.
And in the meantime, you go to another market, and I could say a specific market in the Midwest where the county treasurer, as long as you get a loan from a depository institution in that county, the county treasurer will take out a CD and forego up to 3% interest to buy your interest rate down. It's a solution. No strings attached, no extensive fees.
I saw another question over here.
So thinking about a development that I'm working on in North Corktown, we're at right now in the pre-dev stage, 14 layers of capital, of acronym soup, incredibly expensive money to deliver 60 to 120% residential products with a 7-story building, right? And thinking through how that cap stack gets built, I come back to this elephant that I see sitting in the corner, is that we abandoned public housing as a policy choice 50 years ago. And having for-profit developers in what is fundamentally a subsidy question, building complex cap stacks to do that is, I think, a part of the frustration that settles over most of this room, right? So have any of you thought about what it would look like to have a functioning public housing system in the city of Detroit? And how do you think about the city becoming involved again in making sure that the 50% AMI where this city sits, half the population is below 50% of area median income, it's just math, right? Are never going to be able to afford any of the products that you're talking about because those incomes do not rise as quickly as the structural costs we're forced to absorb because of Detroit.
Yeah, I think it's a really interesting question. I think, shame on us, we didn't have Arthur Jemison here to kind of talk through what the DHC is doing, the Detroit Housing Commission. So there's housing commissions and housing authorities throughout the country that shepherd this legacy government-funded and owned asset class. You can technically take a housing authority project, for example, and do a rental assistance demonstration project, which shifts the ownership from the private or the public entity to the private entity. So you effectively are using tax credits or any other financing tool, and it shifts into a private market scheme where you can then recapitalize the projects as you need to, do the upgrades, create a structure that actually works for the residents at the income that they were already getting, because you can then layer in the vouchers, and then also bring in other private capital. I think we are probably 15 years behind most other major cities in terms of how we treat our housing authority. And I'm very happy that Arthur's there because I think that for so long, we've treated our housing commission as just a voucher provider when it can be so much more than that. I mean, like if you look at the amount of units that they own across the city, they're probably the largest landlord, honestly. So I think you have to think about what role is the housing commission and should it play in the city's affordable housing or housing strategy in general. I think the other thing is like they have expansive campuses. So if you can think about even for sale opportunities because you can then use a voucher for that as well. Right? So I think they're doing some creative things, and obviously there's more to do, but I do think that we have to bring them into the conversation in a more pronounced way because there are viable ways of creating more housing production and doing it for the folks that are making 30 to 50% or even below.
We got time for one more. I saw John's hand here. Grab the mic here.
You mentioned there's no liquidity in the city for exiting projects. Can you talk a little bit about why?
Yeah, I can quickly chime in on some of this. So the challenge is when we have a situation when a new property or a new owner comes in, the property transfers. and a lot of times those taxes uncap. And the new tax burden to a new buyer is so enormous that they can't buy the property. It actually is a very meaningful change in the value. Using those formulas that Cliff was talking about earlier, the expenses just become wildly not viable. So it's very difficult to attract capital when you've got a situation where it's an underwater type of situation. So liquidity is a requirement. You need to have a functioning housing market where properties can transact, where people can come in and breathe new life into buildings. We've found some benefit using the Opportunity Zone program, so we really haven't talked about that at all today, but that's an interesting way to attract equity. And it's a program that's a national program, and it's designed to help capital move around the country to places that would have otherwise maybe not received investment. And we've been able to attract over $100 million of equity into the city of Detroit using that program. And that's helped some of it. But going forward, we do need a functioning market with lots of different participants. It's great that we have lots of landlords in Detroit. That 50,000, I thought, was the number that Edward showed. It's also a challenge because it's hard to get everybody to unite and work together and figure out how to make the market function more normally like other cities do.
Hey, Justin, I know we're out of time.
Yeah.
I don't want to leave it with a negative. I don't want you to just hear the fact that it's hard to do work in Detroit. The flip side of it is there are a ton of people, everybody in this room included, who is invested and engaged in how do we make this work. This city is an amazing city with a living soul, right? And it's not just the history, it is the people who exist in the city. It is the fact that for all of my complaints about the challenges of doing work here, I could not have started a development company in any other city where CDFIs would have propped me up, where Melinda Clemens would have fought for me, where Dave would have said, hey, start with a small deal, and then when I bring him a huge deal, he said, I'm gonna back you anyway. And so I don't just want to leave it with the negative, I want to leave it with the positive that on the flip side, there are a number of amazing people at all levels, at the MEDC, at the CDFIs, at the city, who are trying to make this work and who believe in the city.
I think that was great. Thank you very much, everybody.